Corporate actions. Having covered methods to calculate intrinsic value and to screen companies using quantitative and qualitative factors, we now turn our attention to corporate actions that can impact share prices. Dividends. Dividends can only be paid if a company reports a profit and are therefore distribution of a portion of earnings to shareholders. This is often motivated by management trying to keep its shares attractive for investors. Dividends for a financial year are recommended by the board of directors and approved by shareholders. The key terms to know are: cum dividend. This means the shares are trading with the dividend included. Ex-dividend. This means the shares do not include the dividend. In the example, this means the shares should fall by 20 cents on the ex-dividend date. Bonus issues. Companies that are short on cash but still want to give a payout to shareholders may issue bonus shares. Shareholders will not be immediately better off as the market will adjust the price of the shares proportionately. Shareholders can sell the bonus shares for cash to meet their liquidity needs. Shareholders can also keep the shares. If the company is profitable and continues to grow, the share price will likely appreciate in value over the long run. An example would be in a 1-for-10 bonus issue, shareholders get 1 share for every 10 shares owned. Rights issue. Companies use rights issues to raise new capital from existing shareholders. Shareholders are given the right, but not the obligation, to purchase additional shares at a specific price known as the subscription price within a specified time period. The subscription price is also known as the rights exercise price and is usually set at a discount to the current market price. Furthermore, rights may be renounceable, that is, listed separately and traded eventually on the stock exchange, or non-renounceable, which means if they are not subscribed to, they can expire worthless. Since additional shares will be issued under a rights issue, there will be dilution of existing stakes, and the market will adjust the price downwards to take into account this dilution. Rights issue calculation. ABC shares are trading at $1.20. The company announces a renounceable 1-for-5 rights issue at $1 per share. To get 5 shares, an investor has to pay $6. To subscribe for the rights share, he has to pay an additional $1. He now owns 6 shares for a total cost of $7. The theoretical price per share after the rights issue, which is known as the ex-rights price, is $7 divided by 6, or about $1.17. Rights issue calculation of the value of the rights. Shareholders who don't want to increase their investment in the company can sell off their renounceable rights before the closing date. The value of the rights is given by the theoretical ex-rights price minus the subscription or exercise price. Using the previous example of ABC Company, this would be $1.17 minus $1, or 17 cents. A shareholder who does not want to subscribe to the shares can then sell his or her rights for 17 cents per share. An investor who buys the rights at 17 cents will have to pay the company $1 to get 1 new share. His total cost would then be $1.17, the same as buying it in the market. Share buybacks. Management may choose to use excess cash to buy back the company's shares. Shares bought back are cancelled, thereby reducing the total number of shares in issue. Share buybacks are positive for shareholders because they are usually done when the management feels that the company's share price is undervalued. Theoretically, buybacks should raise the share price as profits and dividends are spread over fewer shares. However, share buybacks can be negative if they are done when the company's share price is overvalued and the buybacks are funded by debt instead of cash. This message is brought to you by Institute for Financial Literacy, a collaboration between MoneySense and Singapore Polytechnic International.